The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Hongbin Jeong. Now, the unveiling of DeepSeek was a catalyst for investors to sit up and take notice, underscoring the reality that tech is no longer a guaranteed source of outsized returns. In turn, the increasing competition and regulatory scrutiny may just further weigh on the tech sector in the near term. But traditional sectors, they've demonstrated resilience. This now highlights that old economy companies can still generate solid returns, particularly in an environment of normalized interest rates and stable economic conditions. So what are some old economy stocks investors can consider, and why might adding old economy stocks be crucial in the current market condition? Well, joining me to find out more is Gary Dugan, who is the CEO of the Global CIO Office. Gary, welcome back to the show.
Thank you very much.
All right, Gary, just for some context here, what are old economy stocks?
Well, the old everyday life, right? So when I think about somewhere like the United States, and these are companies that have done well recently, it's a McDonald's, it's a Walmart, it's a bank, and it's not all those exciting tech companies that are too often talked about.
Right. Okay. So the launch of DeepSeek left not just NVIDIA, but other big tech names and AI-related stocks into chaos. And this led investors to old economy stocks, which showed resilience in the recent event. Why are old economy stocks becoming more attractive to investors again?
Yeah, I think it's the relative game. So if you look at those technology companies, they typically trade on very, very high valuations. They don't pay you very much dividend, and they perform very, very strongly. And so when you get a little bit of bad news, those stocks start to struggle. But in the background, your everyday life, okay, we carry around a mobile phone, but we do a lot of old economy things. We go to a bank, we take out insurance, we eat, we live, we drive cars. Yeah. And all these things are clearly linked to companies in the stock market that you can invest in and still get good returns from.
I see. So which are some old economy stocks investors are currently eyeing? What kind of potential returns are they providing investors in the current market environment?
Yeah, well, I mean, one sector that's done exceptionally well globally over the last 12 months has been the banks. Interest rates which are relatively high, which of course is not to everyone's benefit, but that's good news for banks. General activity in the economy is good news for banks. So we've had a good, strong performance, but I still believe that as we go through this year, we've still got good global growth and we've got relatively high interest rates. And then one other is healthcare. Healthcare, again, was in the backwater of the stock market. It used to be one of those old growth sectors where there are some new technologies, some new drugs coming through across the industry, which are giving us a new dimension of growth. So those are two I would pick out from the performances we've seen recently.
I see. Well, is there a big gap between old economy stocks and new economy stocks? I mean, what's creating this discrepancy?
It's just a weight of money. So everyone's gone, well, if I can find a company in the tech sector that's growing at 25, 30%, why do I even bother looking at the other companies? And those other companies, therefore, have fallen in value in their valuations relative to tech. So people are saying, well, I'm now losing some money on some of these tech stocks I bought recently because there's been certainly a bit of a setback. And therefore, the old economy companies are going to give me a good dividend yield of 3 or 4%. As well as some capital appreciation. And they are, I'm told, cheap. So that's why we've started to see a weight to market going back to the old economy.
I see. Well, some analysts say that the attraction of old stocks and the downturn in technology has been caused largely by market volatility. Why is such market instability leading investors to old economy stocks? I mean, what makes them so attractive in this type of market condition?
Yeah, those technology companies have done well, but they do have a lot of volatility. But, I would say the best stock out there in terms of tech performances in recent years has been NVIDIA. Now, NVIDIA went up very rapidly and has contributed to much of the growth of the US equity market. But now it's gone sideways for about 6 months. So when people see that, I'm making no money from this company, and yet some days it's down 5% and some days it's up 5%. Too much risk for me. I'm going to go and find something safer. So we're looking at, even in the institutional world, portfolio managers are shifting their portfolio to companies with less day-to-day volatility, more secure income, and just moderate growth into the future.
Right. Well, do you think that the shift towards old economy stocks could be a sign of a broader change in investor sentiment? And if so, what does this tell us about the current state of the market?
Yeah, I think there's a general, I don't say tiredness, and it's, of course, been very focused on the US because other parts of the world, including your own local market until last year, had been very, very quiet relative to the excitement of the US. But I think it's just feeling that the US in particular has just gone too far. Yeah, there's obviously more day-to-day geopolitical challenges. There's a debate about, maybe the Federal Reserve is not going to cut interest rates so quickly. We're hearing more and more of our clients in particular saying, I want income. Give me the security of income. Give me 3 to 5% dividend yield and a company that is safe and secure. Now, but I would say that we haven't given up on technology. Technology is going to become a bigger part of our life. But it's just that we were paying too much for those technology companies, and they need their profits to catch up with their price performance.
Right. Well, then how important is valuation in the renewed interest in old economy stocks? Are these companies undervalued compared to their high growth counterparts?
I would say it's region by region. So I'm not so sure that the US defensive or, old economy stocks are so cheap. But you've definitely seen a lot of cheapness across Asia, the Chinese market, and then across into Europe. I mean, we have European companies. I'll give you one example, Pernod Ricard, which is a big brand name in the drinks business, trading on a P valuation of 13. Now, if that was an American company, it might be 18. So there's been this tremendous gap between the valuations of old economy companies outside the United States. And that's why more recently we've seen, for example, the European equity market up 8% year to date, whereas the US market was only up 2%.
I see. Well, given the resurgence of old economy stocks today, are there any potential risks or downsides of investing in such stocks then? How can investors mitigate these risks?
I think there's less risk considering that they've not really performed in recent years. But the risk will come if we think that the global economic scene is not going to be as vibrant as we currently expect. But, I would say expectations are generally quite low. So across the world, most economists will say that we're going to grow around 2% this year in the old economy, 4% in the emerging world. I'm not sure there's a lot of downside risk on those. I would say that we do need faster pace of cuts in interest rates. So we'd like to see a little less inflation. If we get a little less inflation, I think those old economy stocks will do even better. But you should be targeting a return of somewhere between 7 and 10% from those old economy stocks for the balance this year.
I see. Well, what role does diversification play in the decision to allocate funds to old economy stocks then, particularly during uncertain times in the market? Are you seeing an increase in investors allocating funds to old economy stocks at the moment?
Yes, we do. And I think there's definitely some profit taking going on amongst the technology companies. And I think just a realization that probably people, just through the price appreciation of many of those companies that have done so well, has unbalanced their portfolio too much towards risky stocks that do have day-to-day volatility. We have seen that stocks can correct by 15 or 20% in a day just with a bad story for a day. And so, you can't live your life on the edge, should I say. So it's keeping the balance between these two things. The best way of thinking about it is that a typical portfolio would have something like 60 to 70% in old economy and 20 to 30% in the new economy. Wow. And that's probably the easiest way to live your life and not have concerns from minute to minute.
I see. Well, before we let you go here, Gary, overall, do you see the return of interest in old economy stocks to be short-lived, or is this a key area to watch in 2025?
I think it's a key area to watch because if interest rates come down quickly, they could perform. If nothing happens, I think they will do better than the technology companies. I think there's an unraveling here a little bit of the too much excitement around technology. So, as I said, it's a safer place to be, but it's not just a safer place to be with no return. It's actually a safer place to be with a good 10% return.
I see. Well, thank you so much, Gary, for your time and your insights today.
Thank you.
Thank you. That was Gary Dugan, who's the CEO of the Global CIO Office. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.